Hey y'all, it's Ashley from A&L Bookkeeping. Today we're going to talk about something that sneaks up on a lot of shops. It's about your equipment. Buying it is the easy part. Tracking it so that your margins, taxes, and financials don't lie to you is the harder part. One wrong move with equipment can throw off your cost of goods. It can inflate your profit. It costs you real money. So I'm going to try to break this down the simple way. Hang on for the ride. Your inventory versus fixed assets are not the same thing, okay? Inventory are the parts you buy to resell or install on customer jobs. Think turbos, injectors, clutches, brake kits, tuning devices, all the stuff going on customer cars. Your assets is going to be the equipment used to run your shop long-term, like lifts, welders, scanners, shop trucks, dynos. Your inventory is going to affect your job margins. Your assets affect your balance sheet and your tax strategy. Different buckets. So, capitalize or depreciating versus expensing. The easy, quick kind of rule is if it lasts more than 12 months, it probably should be depreciated. A lot of tax professionals use a threshold, usually around $2,500. If it's under $2,500, you can expense it. If it's over that, you capitalize it or depreciate it. And that can change. It's not a hard and fast rule. It can change based on your tax strategy, and it can change based on what your CPA may recommend. So it's good to leave it in the air or check with your CPA. We work closely with CPAs, so we get a feel for how they like to treat things like that. So we just go ahead and book it that way to start with. But some examples for you. $400 shop vac, you're going to expense it. A $4,000 compressor, you want to depreciate it. A new dyno upgrade, $12,000, depreciate it. When you're doing that, it means you're not writing it off all at once. You spread it out over time, unless you use maybe some special tax elections, but that's a whole nother story. Now, depreciation is spreading out the cost of equipment over the years that you plan to use it. Usually, a good rule of thumb, your tools and equipment you can depreciate for 5 years, vehicles 7 years, buildings and improvement between 15 and 39 years in some cases. If you expense something big in the wrong spot, your profit looks crazy. Low one year, high the next, which leads to inconsistencies in your books. When you have steady depreciation, that equals clean books, predictable cash flow, and better financial decisions. Now, when you're repairing versus upgrading, keep this in mind. Repairs means that you're keeping something running. It's usually an expense. An upgrade is going to make it better or adds capability. You're going to want to depreciate that in most cases. Replace a belt is an expense. Add an attachment that does more jobs, depreciate it. Fix a dyno sensor, expense it. Upgrade horsepower range, depreciate it. Now, this matters because when your equipment is tracked, you're going to understand and see real margins, clean financials. You'll get better tax deductions, and you'll have a better and clearer cash flow planning outlook. You're going to be able to make smarter decisions on buying and upgrading. Now, when it's tracked wrong, you get a little more chaos. You can have bad margins, more or less incorrect profit, missed deductions, and where did all the money go kind of questions. Good equipment tracking isn't boring bookkeeping. It's how you grow your profit on purpose. It's the next strategic step that you want to make in the growth of your business. So if you want help cleaning up your equipment list or figuring out what belongs where, that's exactly what we do every day. We're here to help.